All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Tuesday, everybody. Today is July 29th, 2025. I said 28 yesterday. Fast forward a little bit there, but I digress. The top story this morning, guys, earnings season is hitting full stride here. We got some numbers today. We got a lot of companies reporting: UPS, Whirlpool, United Health. Look, none of these earnings, I mean, there's some silver linings in there. There's some good stuff going on in the economy. We'll talk like Boeing's not terrible for a change. But look, every corner of the economy this morning is showing some signs of trouble. Whirlpool, disastrous. Massive cut to their guidance. They're blaming tariffs. Whirlpool manufactures their washers and dryers and dishwashers and refrigerators in the United States. What are they blaming tariffs for? Well, they're claiming Asian manufacturers have been stockpiling appliances, and that's why their earnings are so bad. Wait, what? Asian manufacturers stockpiling? How does that affect Whirlpool? Are the Asian manufacturers stockpiling so much that they're lowering their prices and Whirlpool's not competitive? Well, then what's the whole point of stockpiling inventory if you're just going to slash prices? The point was to get in ahead of tariffs. Doesn't really make a lot of sense, the excuse that Whirlpool is offering. I have an idea. People aren't buying appliances because the economy sucks, because they're broke, because the housing market sucks. Maybe that's why appliances aren't selling. Maybe it's got nothing to do with tariffs. We also got UPS withdrew their guidance, or I should say withheld their guidance. UPS, bellwether of the economy. Are packages moving or aren't they? They withdrew their guidance in April off of the uncertainty of the tariffs, right? There was a lot of things going on. The de minimis tariff exemption went away for small packages coming in from China. UPS has this ongoing separation that they're doing with Amazon. A lot of people were expecting UPS to bring their guidance back, though, and they didn't. And this is as the company is closing distribution centers, as they're offering voluntary separation packages to drivers to try to trim headcount. And the UPS CEO has some pretty alarming things to say about consumer confidence today. UPS not doing so well. United Health, their guidance disappointed. They forecast $16 a share for 2025 adjusted earnings. The market was expecting $21 a share, a big cut to United Health guidance this morning. This is after the abrupt departure of their CEO and the announcement of criminal investigations at United Health. That stock is down again this morning. It's already down 44% year to date. Union Pacific Railroad, they're buying Norfolk Southern. Okay, that's actually, we'll put that in the good news today. Big merger of two different railroads. It's an $85 billion deal, and now rent on the railroads will be $200 every time you land on one. Spirit Airlines furloughing 270 pilots. Another 140 are getting demoted. We got trouble in the airlines this morning. Pharmaceuticals this morning. I don't usually cover the pharma stocks, but some of them are getting just absolutely destroyed here. Novo Nordisk is down over 20% after they cut their guidance. They're worried about lower growth in obesity drugs, Wegovy and Ozempic. You got Merck is planning $3 billion worth of cost cuts, otherwise known as layoffs, by 2027, trying to get ready for their Keytruda cancer drug, which is coming off a patent in 2028. They're also citing tariff concerns. All right, Boeing had a decent quarter. It's still a loss. They still lost over $100 million, but that's down from losing over $1 billion last year. So I guess even the good news isn't really good news. Like, hey, good news, Boeing is losing money, but they're not losing as much as last year. So I got that going for me. That company has just been going from crisis to crisis. Proctor and Gamble's raising prices in order to offset tariffs. Look, guys, we got trouble this morning in shipping. We've got trouble in appliances. We've got trouble in healthcare and pharmaceuticals, trouble in airlines. But the market, it's up. Everybody's just looking forward to big tech earnings that start tomorrow. Every corner of the economy has some manner of squeaky wheel this morning, and nobody cares because my data centers, because my AI, because eventually this shiny new thing is going to make everybody a lot of money. We don't know how. We have no plan to commercialize these products whatsoever. We're bleeding cash. We're losing money, investing it by the billions, but it's resulting in no increase in our earnings. Doesn't matter. Phase 3 profit. Sooner or later, all these other corners of the economy are going to start mattering again. But it is not this day, apparently. Also, we got some other information coming out. Interesting article in Bloomberg this morning about commercial real estate, talking about CMBS's, talking about how commercial real estate is paralyzed, how commercial real estate is in a state of suspended animation. Look, guys, the thing hasn't moved in 6 months. Poke it with a stick. It's starting to smell. It ain't paralyzed. It's freaking dead. Commercial real estate has a big problem. And there's one little sentence in that article about commercial real estate that is an aha moment. Aha, I knew what they were planning. Look forward to that one towards the end of the show. And we also got trade balance data. We will find out just how big of an impact the trade war and the tariffs are having on our GDP. Guys, we have a loaded show this morning, and we are going to fly through these corporate earnings to make sure we have time to touch on all of them. So with that, why don't we shrink my big melon of a head? And let's see what's going on in the market this morning. I have the wrong window queued up to start. I apologize for that. Hey, by the way, hit that like button and that subscribe button for the YouTube algorithm, because we do this every day. So come on back tomorrow and have your coffee with the melon heads. Right now, the S&P is in positive territory, up 11, almost 12 points. 0.18% to the upside for the S&P. The Dow is also just barely positive, 30 points to the upside, or 0.07% higher. And the NASDAQ, of course, leading the way higher, up 0.38%, 88 points to the upside. It doesn't matter how bad corporate earnings are, tech stocks go up in absence of catastrophic news. Meanwhile, we've got a stronger dollar. You notice since the trade deal got announced with the Europeans, the Dixie has been surging here, back above 99. We're at 99.1, up another 43 basis points today. That's after rising yesterday. So pay attention to that DXY here. Obviously coming up on the 100 level. That'll be a big psychological barrier. Looking over at the bond market, I am remiss once again because I do not have the U.S. bond market queued up here. Bear with me for a second, guys. Sorry, we had a lot of earnings to get through this morning, and it slowed me down. Oh, come on. Let's get through the stands. Let's get through the UK. There we go. All right. The bond market, we got yields are lower across the board this morning. The 30-year, 4.939. That's down by 2.5 points. The 10-year, 4.397, down 4.5 points. We've got the 2 years at 3.910, off by a point and change. And the 1 month is down almost 1 basis point at 4.333. So we got bond prices a little bit higher this morning. That means lower bond yields. Looking over at the commodities board, we got a little bit of a mixed bag here. We've got spot gold is at $3,320. That's higher by $6 this morning, or about 0.2% to the upside. Spot silver, meanwhile, is down by about 8 cents, $38.08, off by about 0.2. Overnight, we hit a low of just below $38 for spot silver. We went as low as $37.91. But I would point out September silver futures are still just barely green here. Either way, I like the shiny. There we go. I had to open my big mouth. Then they went red. But I like the shiny. We've got copper is higher by 0.3%. Platinum is up 0.6%. Palladium down 0.9%. And September WTI futures are at $67.39. That's higher by about 68 cents, or 1% higher this morning. Looking over at Bitcoin, we've still going a whole bunch of nowhere for Bitcoin. We've been in this consolidation pattern for about 2 weeks now. $118,837 on Coinbase. That's up by about $700 from yesterday. Guys, the one thing about Bitcoin you got to notice, or at least you got to take note of here, Bitcoin absorbed a $9 billion sale without batting an eyelash, right? We had that story last week about that Bitcoin whale who moved all that Bitcoin from 2011. There's a lot of theories out there. Some of the online detectives have traced some of that money back to a hack that happened in 2011, possible some shenanigans going on there. But the point is $9 billion worth of Bitcoin was sold. There was a dip down. The market bought it right back up. And now here we are still in this consolidation pattern. So, I mean, that's noteworthy that Bitcoin has deep enough liquidity to absorb a sale like that. Doesn't mean it can keep up. It doesn't mean that's going to go on forever. But that does mean that there's still pretty deep pockets supporting this market for the time being. As always, be careful on leverage, guys. Crypto winter is coming eventually. All right, let's get into some of these earnings this morning, starting with a big one, UPS. They withhold their outlook on market upheaval after mixed quarter. What market upheaval? Stocks are at all-time highs. Gold is near all-time highs. Real estate housing near all-time highs. Bitcoin near all-time highs. What market upheaval? All right. Do we have market upheaval? It's not in the market wherever the upheaval is. I'm not saying things have not been upheaved. There may be some upheaving going on over there somewhere, but nobody cares because big tech earnings. United Parcel Service declined to provide earnings guidance as it struggles to get a handle on volatility in the market, underscoring the challenges for the courier's effort to reconfigure its network and revitalize its business. The company said Tuesday that it would not give a revenue or operating profit forecast for the full year, given the current macroeconomic uncertainty. UPS offered limited predictions around capital expenditures and dividend payments in 2025 and said it still expects $3.5 billion in expense reductions from its ongoing turnaround plan. And expense reductions is a very polite way of saying cutting jobs. Let's read a little bit on here. To solve some of its woes, UPS has said it's excising more than half of its Amazon business, which represented as much as 11.8% of UPS's total revenue last year. As it pulls away from its largest customer, UPS is focusing on shipments that bring in higher margins rather than low-value e-commerce parcels. To reorient around smaller volumes, UPS is closing and consolidating facilities and automating them, as well as reducing headcount. Earlier this month, the company offered its first ever voluntary separation agreement to full-time union drivers. The offer includes $1,800 per year of service with a minimum payout of $10,000 for drivers to leave the company. The buyout reflects the unprecedented moment that UPS finds itself in. After more than a century of continual growth, the company is now seeking to slim down its delivery network and with it, its ranks. So UPS is cutting people, they're cutting distribution centers. Also saw this quote here from Financial Juice, quoting the UPS CEO, saying the U.S. small package market was unfavorably impacted by U.S. consumer sentiment that was near historic lows. Again, guys, the situation, the macro situation does not match what asset valuations in the market are showing us. You've got UPS. This guy is literally got his finger on the pulse of the economy. He moves everything in the economy, and he's talking about package unfavorably impacted by consumer sentiment near historic lows. How do you jibe that with these valuations at all-time highs? It's not business booming. It's just money becoming worthless. That's what we're watching. UPS stock down 4.4%, trading at $97.10. That's off by more than $4 this morning. Another one that's hurting this morning is Whirlpool. Now, this one kind of doesn't pass the sniff test with me. Whirlpool cuts dividend and full-year profit guidance as tariffs hurt quarterly results. And the story they're offering about tariffs doesn't really hold water with me. Appliance maker continues to contend with effects of Asian manufacturers stockpiling imports in the U.S. It's definitely not because their washers and dryers are garbage or the fact that the housing market is frozen. No, it's Asian manufacturers stockpiling inventory. Okay. Whirlpool cut its full-year profit guidance and lowered its quarterly dividend as it continues to contend with the effects of Asian manufacturers stockpiling imports in the U.S. market. The appliance maker said Monday it now expects adjusted earnings per share of $6 to $8 for the full year, down from its previous guidance of $10. Big cut to their guidance. Analysts polled by FactSet expected adjusted earnings of $8.96. The company maintained its full-year sales outlook, guiding for net sales of $15.8 billion. Still, the Michigan-based company continues to expect an eventual boost from U.S. trade policies as its competitors raise the prices of their foreign-made washing machines, refrigerators, and dishwashers as higher tariff rates take hold throughout the second half of the year. Whirlpool also expects to benefit from a healthier housing market. The company said a recovery in existing home sales should drive higher discretionary demand for appliances in the mid to long term, while the multi-year expansion of new housing in the U.S. after years of undersupply should provide further long-term upside. Where is this optimism in the housing market coming from? Has anybody looked at the housing market recently? There isn't one. There are no houses being bought or sold. They're just sitting there. Transactions are at ridiculous lows. Prices may be stubbornly high, but they're not moving. Look, this is a pretty lousy report from Whirlpool here. And look at what the stock is doing, down 16.9. Let's refresh this one. Whirlpool stock down now 12%, trading at $86. off by $11.76 this morning. So, a little bit of optimism about the housing market from Whirlpool. I don't know where it's coming from. They're claiming these Asian manufacturers stockpiling inventory is somehow affecting their sales. The mechanics of that totally eludes me for the time being. But you can add Whirlpool to the list of companies that are really struggling here. And that list also includes United Health. They say 2025 earnings will be worse than expected as high medical costs dog insurers. My heart goes out to United Healthcare, really. I mean, there could be tears. United Health Group on Tuesday issued a 2025 outlook that fell short of Wall Street expectations as the company's insurance unit continues to grapple with higher medical costs. Shares of United Health fell more than 4% in pre-market trading. The company anticipates post-2025 adjusted earnings of at least $16 a share, with revenue of $445 billion to $448 billion. Wall Street analysts had expected 2025 adjusted profit of $20.91 a share on full-year revenue of $449 billion. So this guidance was a big miss for United Health. The stock tumbled in May after the company suspended 2025 guidance due to elevated medical costs and announced the abrupt departure of former CEO Andrew Whitty. I remember when that abrupt CEO departure was announced, I said, something bad is coming. CEOs don't abruptly depart for no reason. And then a few days later, we found out about the criminal probes into their Medicare billing practices. The report Tuesday adds to a growing string of setbacks for the company, which owns the nation's largest and most powerful insurer. United Health is often viewed as the industry bellwether. And right now, that industry bellwether is down 4.4%, trading at $269.51, off by more than $12. And look, that down 4.4%. It's already down 44% year to date. This company is in bad shape here. Now we got a little bit of positive news. Union Pacific will acquire Norfolk Southern in an $85 billion deal. I don't know if this is good news. It's certainly not terrible news. The trend of consolidation continues. We're seeing it in banks. We're seeing it in retailers, media companies. Now we're seeing it in railroads. So I guess maybe that's not a good thing, but at least nobody's like going out of business here. Union Pacific agreed to acquire Norfolk Southern in a cash and stock transaction valued at $85 billion, forming a transcontinental rail behemoth in what stands to be the industry's largest deal ever. The deal implies a value of $320 a share for Norfolk, the company said in a statement on Tuesday. The purchase price, confirming an earlier Bloomberg News report, would represent a roughly 23% premium to Norfolk Southern stock before the first reports of a potential deal this month. It's also the largest deal of the year announced so far, according to data compiled by Bloomberg, providing a boost to the M&A market. And I would add that the advance to the nearest railroad chance card has still not been turned over, so there could be some value hiding in that deal as well. Sorry, I really like Monopoly. Union Pacific, that stock is up 1.2% on this deal, trading at $232. Meanwhile, Norfolk Southern is actually down 2%, trading at $281. So not a lot of movement in either stock this morning, but we got some merger activity. Now back to the airlines here. Spirit Airlines to furlough 270 pilots and demote 140 more on downsized schedule. The trouble in budget airlines continues. Spirit Airlines said Monday it'll furlough 270 pilots while demoting another 140 as the cash-strapped budget carrier looks to scale down its workforce to match a downsized schedule. The furloughs will go into effect on November 1st, while designation downgrades for captains will take place on October 1st, the company told Reuters in an emailed statement. The Florida-based carrier had filed for bankruptcy protection last November following years of losses, heavy debt, and failed merger attempts. It emerged from bankruptcy in March, and it looks like things still getting worse for the people who work at that airline. Down another 2.4% this morning, also down 52.5% year to date coming out of bankruptcy. Trouble in the airlines to go with the trouble in healthcare and appliances and transports. What about pharmaceuticals? Well, not so good in pharma this morning either. Obesity drug maker Novo Nordisk plunges as it cuts forecasts again. This stock is getting clobbered here. Obesity drug maker Novo Nordisk on Tuesday cut its full-year sales and operating profit forecast for a second time this year, sending its shares down as much as 17%. The maker of weight loss drug Wegovy is struggling to convince investors it can remain competitive in the obesity drug boom against U.S. rival Eli Lilly. Novo shares have fallen sharply over the past year. The lowered outlook for 2025 is driven by lower growth expectations for the second half of 2025. This is related to lower growth expectations for Wegovy in the U.S. obesity market, lower growth expectations for Ozempic in the U.S. GLP-1 diabetes market, as well as lower than expected penetration for Wegovy in select international operations markets. Novo now expects sales growth of 8 to 14% in local currencies, down from previous 13 to 21 forecast range. It also lowered its operating profit growth estimates to 10 to 16%, down from 16 to 24%. And look at this stock. This is down big this morning. Let's refresh. Down 21% ahead of the opening bell, $54.34, off by $14.68 this morning. This one's getting clobbered. Another pharma stock not doing so hot this morning is Merck. They're planning a $3 billion cost cut by the end of 2027, and they narrowed their full-year outlook. Merck on Tuesday said it'll slash $3 billion in costs, otherwise known as layoff people, by the end of 2027 to be fully reinvested to support new product launches and its drug pipeline. The multi-year effort comes as Merck prepares to offset revenue losses from the upcoming patent expiration of its blockbuster cancer drug Keytruda in 2028. It also comes as drug makers brace for President Trump's planned tariffs on pharmaceuticals imported into the U.S., which has prompted Merck and other companies to invest billions to boost their manufacturing footprints in the United States. As part of the effort, Merck in July approved a new restructuring program that'll eliminate certain administrative, sales, and research and development positions, but the company will continue to hire employees in new roles across growth areas of its business. They'll also reduce their global real estate footprint and continue to pare back their manufacturing network. They expect the actions under the restructuring program to generate around $1.7 billion in annual cost savings, most of which will kick in by the end of 2027. They expect pre-tax costs related to the restructuring program to be about $3 billion in total. For the second quarter, Merck recorded a $649 million charge related to the program. Also on Tuesday, Merck reported second quarter revenue that came in short of estimates. It was the first time that the metric had missed expectations since April of 2021. So we got that one is down 4% pre-market here, $80.64. Guys, almost every one of these companies is getting clobbered this morning, and yet the market is up. Why? Because of tech stocks. Tech stocks are dragging everything higher. Now, we do got some good news here. Not great news. Boeing slashes loss as CEO touts our turnaround year. Boeing is losing money, and that is good news. Very 2020s headline. Boeing slashed its quarterly losses as sales jumped after it delivered the most airplanes since 2018, the clearest sign yet of improvement at the manufacturer that has swung from crisis to crisis for years. The aerospace giant lost $176 million for the 3 months ended June 30th. That's down, though, from $1.09 billion a year earlier. Revenue rose 35% to $22.75 billion, up from $16.87 billion last year. Adjusted for one-time items, Boeing reported a loss of $433 million, or $1.24 a share, better than the loss analysts had expected. For the 3 months ended June 30th, Boeing handed over 150 airplanes. The last time it delivered that many planes in a second quarter was in 2018, which was also the last time Boeing posted an annual profit. The company still has challenges ahead. Boeing said Tuesday that the long-delayed certification of the Boeing 737 MAX 7 and the MAX 10, the smallest and largest members, respectively, of the MAX family, likely won't come this year, as Ortberg forecast in May. Also, Boeing's defense unit has been riddled by charges in past quarters, and as of Sunday, could face a factory worker strike after employees voted down a new labor deal. So Boeing not out of the woods by any measure, but things certainly look a hell of a lot better than they did last year. Boeing stock is up 1.7%, trading at $240.40, up almost $4 ahead of the opening bell. And the last one from the earnings front today, Proctor and Gamble hikes U.S. prices amid tariff challenges and a CEO change. All right, so, a lot of people talking about tariff inflation. Will it, won't it? Well, I guess it will, but when will it? There's some clues in here about when we could see this in CPI. Procter and Gamble on Tuesday forecast annual results largely below estimates and said it would raise prices on some products in the U.S. a day after naming insider Shailesh Jejurikar, how's my pronunciation, as its CEO to steer it through tariff uncertainty. The consumer goods bellwether shares rose nearly 1% in pre-market trading as it topped fourth quarter estimates. That's interesting because in the previous paragraph, they said they forecast below estimates. Okay, they reported their previous quarter was above estimates, but their forecast was below. Now I get it. P&G said it would raise prices on about a quarter of its products in the U.S. starting this month to help offset the cost of new tariffs imposed by President Donald Trump. The price hikes have been communicated to retailers such as Walmart and Target and are in the mid-single digits across categories, a spokesperson said, and will be seen on shelves starting in August. That's important there, all right? So they're raising prices now. They'll be seen on shelves starting in August, which means they won't show up in CPI data until probably September, which means the full effect in CPI probably won't be seen until October or November. So tariffs will eventually cause some inflation in some sectors of the market, but it's going to be several months before that shows up in any of the data. The comments from the world's largest consumer goods maker reinforce how consumers, particularly in the lower income category, are seeking value as they look to stretch their household budgets. Packaged food maker Nestle said last week that consumers in North America remained weak. There's another CEO, another company talking about weak North American consumers. Proctor and Gamble, which makes household basics spanning from Bounty paper towels to Metamucil fiber supplements, estimated tariffs will increase its costs by about $1 billion before tax for fiscal 2026. That compares with prior projections of between $1 billion and $1.5 billion made back in April. All right, so it's going to cost them $1 billion. They will be passing that on to consumers, but not as much as previously feared. Let's see, Procter and Gamble stock is right now a whole bunch of white screen. Looks like Yahoo Finance not wanting to cooperate. There we go. Oh, opening bell has rung, and stock is now actually down a few pennies. This one was up a few percent on that news earlier this morning, giving up all those gains now. All right, this was an interesting article about commercial real estate. That story that everybody just wants to go away, but it won't. When you have hundreds of millions of dollars or billions of dollars worth of debt against buildings that are not worth anywhere near that debt, the people you owe the money to tend to not just go away. All right. We'd all like to pretend, but it doesn't work that way. CMBS linked loans worth $23 billion are gripped by paralysis. And by the way, Dr. McCoy says he's not paralyzed. He's dead, Jim. All right. When something doesn't move for 6 months, yeah, maybe it's paralyzed, but you smell that? Yeah, it's dead. More commercial real estate debt is entering a state of suspended animation. It's not dead. It's just suspendedly animated as the ripple effects from the pandemic continue to reverberate through the industry. About $23 billion of delinquent commercial mortgage loans bundled into bonds have reached or are approaching their maturity dates, according to an analysis by data analytics firm TREP, with borrowers increasingly unable or simply unwilling to repay the debt. That compares with virtually zero before COVID upended the market. These unresolved loans now account for 3/4 of all the delinquent loans linked to commercial mortgage-backed securities, compared with just 42% in 2022. Despite the pileup of bad debt, so far there has been no prolonged market meltdown in commercial real estate. Real estate lenders are extending the duration of loans rather than seizing properties from borrowers hit by value declines after the rise of working from home made offices in particular less desirable. In other words, extend and pretend. They're just acting like these properties are still worth what they were worth 5 years ago. We all know they aren't. You can't do that forever. Now, this is what really got me. The availability of private credit has allowed some landlords to refinance at higher debt-to-value ratios. All right? Private credit, one of the reasons why we have not had price discovery in commercial real estate. This is important. They're refinancing at higher debt-to-value ratios, which means they're going further out on that leverage limb, further and further out, even though the value of the buildings is going down and down and down. And remember what they're all trying to do. They're all trying to democratize access to private credit. Remember, President Trump is expected to sign this executive order allowing this crap to be put into your 401k. And we just got done talking about how there's billions of dollars of bad debt, how people are unable or simply unwilling to pay it back. And they're so freaking eager to give you the exciting opportunity to get in on the ground floor of this garbage. I'm telling you guys, those phone calls are going to start happening. Your guy is going to call you with this exciting ground floor opportunity to get access to this private markets. It's garbage. It's garbage looking for a place to die. It's not in suspended animation. It's not freaking paralyzed. It's dead. All right, last but not least, guys, we got the trade balance this morning. That is the difference between all of our imports versus all of our exports. And, well, it was down once again. We got $86 billion worth of trade deficit. I mean, we imported $86 billion more than we exported. Now that, number one, it's not good. We're still a net importer by a large margin. But you can't help but notice here, look, 3 months in a row of substantially lower trade deficits. All right, that is clearly the effect of the trade war. All right, you can see we had several months of substantially higher trade deficits in the first quarter in particular. That was all of the front running of tariffs, trying to get all that stuff into the U.S. before the tariffs hit. But it hasn't recovered. We haven't seen that trade balance go further negative yet. There was supposed to be this second wave of rush of imports because of the 90-day delay in the taco trade. That hasn't happened. All right, so we are seeing the trade balance close. This should result in higher GDP in the next quarter. Remember, we had a negative number in the first quarter because of this big surge in imports, a lot of that being gold and silver, by the way. I think it's probably still too early to draw any big conclusions. The higher prices from tariffs will get here long before any reshored manufacturing or new factories get built. So, the story's still being written on this trade war and the long-term effects of it. But for now, we've got a smaller trade deficit in the United States. And I just want to say thank you very much to Nashville Pasta Man. What's going on, Pasta? He says, are the Asian manufacturers in the room with us now? Yeah, I don't get that. How does Asian manufacturers bringing all their inventory into the United States ahead of the tariffs affect Whirlpool's sales? All right, because the whole point of bringing all that inventory in is to avoid having to raise your prices when the tariffs hit, right? So you don't just turn around and lower your prices so you can hurry up and unload that inventory. So what Whirlpool is offering up doesn't really make any sense to me about these, Asian manufacturers importing ahead of the tariffs, causing a decline in their sales, nor does their rosy forecast for the housing market make any sense to me. I don't see, look, it doesn't mean home prices are going to crash tomorrow, but there is no recovery in the housing market. The housing market is frozen solid. It's in a state of suspended animation, if you might say, kind of like commercial real estate is. Yeah, a lot of the excuses being offered up by Whirlpool really didn't make a lot of sense to me, Nashville. I have a theory. People have no money, and so they're not buying washers and dryers. They're not getting new ones. They're keeping their old crap working longer. And they're not buying new houses, so people aren't having the kitchen remodeled to get the house sold faster. That's why Whirlpool is in trouble. I know, crazy idea, crazy concept, or you just believe the crap about the Asian manufacturers. Thank you, sir, for supporting the channel. Clueless Panther, thank you, sir, for supporting the channel. He says like and subscribe. I thank you so much for the good vibes, sir, and the support of the channel. I'm Jack Gamble, and I approve this message. Thank you very much, Clueless. I appreciate that, sir. Hunt and Cover, who has been a member for 17 months, says Melonhead community value is priceless. Oh, once again, I'm Jack Gamble, and I approve this message. Thank you so much, Hunt and Cover. I wish you well, sir. I hope all is going well with you. Thank you for being a Melonhead. Appreciate it very much, sir. How do we say this one? Bompassi? Mr. B, welcome to the Melonhead, sir. We got a new member who just joined us. Well, thank you so much, Bompassi. I apologize if I mispronounce your name. Feel free to message me and correct my non-regional diction, which has never been a strong suit. I don't get out much. Sorry, guys. I spend a lot of time in my little corner of Pennsylvania here, but I do read a lot about what happens elsewhere. And then I tell you what I have found. Thanks again, Bompassi, for becoming a Melonhead member. I appreciate that very much. And thank you, everybody, for having your coffee with the Melonheads this morning. I appreciate that very much. Don't forget that like button and that subscribe button on the way out for the YouTube algorithm if you feel so inclined. Also, thank you to my magnanimous Melonheads on YouTube and Patreon. Thank you guys for supporting the channel. Links down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.